Is DNLI a strong buy? Well, that is the bold question currently dominating technical stock forecasts for Denali Therapeutics right now. It's on everyone's mind, so let's dive right into this and see what the data actually says. Get this, plus 147.73%. That is the staggering short-term analyst price target upside for Denali. I mean, it's a massive figure that immediately grabs your attention, right? And it demands that we unpack the dense financial and clinical data behind it to truly understand why the market is reacting this way. So, welcome to this explainer. I am super excited you're here. Today, we're decoding the data for Denali Therapeutics. We're going to translate a very dense mix of SEC filings, clinical milestones, and technical stock projections into a clear, structured picture. If you've been following the biotech space at all, you know Denali is making waves, and today, we are figuring out exactly why. All right, here's our roadmap for this explainer. First, the Denali inflection point. Second, AVLAY's accelerated approval. Third, decoding their Q1 2026 financials. Fourth, shifts in their pipeline. And finally, fifth, the DNLI stock forecast. Okay, Section 1, the Denali inflection point, science meets finance. So right now, Denali is sitting at a massive crossroads in 2026. They're actively trying to balance some really exciting clinical success with incredibly complex financial structures. Our main objective in this explainer is to completely demystify the specific catalysts that are driving their current market position, as well as their long-term viability. It's honestly a perfect case study of how scientific breakthroughs can immediately complicate a balance sheet.
Moving on to Section 2, AVLAY's accelerated approval, the primary catalyst. Let's bust some regulatory jargon really quick. What exactly is an accelerated approval? Basically, it's a process that allows for faster FDA approval for drugs treating serious conditions that fill an unmet medical need, and it's all based on promising early results. It gets the drug to market much faster, which is absolutely incredible for patients, but it also means full evidence of clinical benefit is still actively being gathered.
And here is the major milestone. In March 2026, the FDA actually granted that accelerated approval for Denali's drug Avilaya to treat neurologic manifestations of Hunter syndrome. This is huge because it introduces Denali's very first commercial revenue stream. What's really interesting here, though, is that this approval also triggered a $36 million milestone payment that Denali went ahead and capitalized as an intangible asset. Now, to figure out how Denali actually funded the massive research operation to get them to this point, we've got to look at a pretty complex financial term, a synthetic royalty funding agreement. So what does that mean? It means a company gets upfront cash in exchange for promising future payments linked to the revenue generated from a specific product. It's a clever way to get liquidity right now without having to issue more stock and dilute your current shareholders. And here's the exact trade-off Denali made. On one hand, they snagged $200 million in upfront cash from Royalty Pharma. But look at the other hand. The cost of that cash is giving up a 9.25% royalty on Avilaya's worldwide net sales. So Denali secured an immediate, non-dilutive liquidity injection, but the long-term cost? They're sacrificing nearly 10% of their future product economics. Which brings us to Section 3, decoding Q1 2026 financials, balancing burn and runway. Let's look at the hard numbers from Q1 2026. The net loss, $128.4 million. Research and development expenses were absolutely massive, coming in at $103.8 million for just the quarter. General and administrative expenses sat at $33.5 million. But, and this is a big but, look at that bottom line. Cash reserves of $1.05 billion. So while their cash burn is undeniably huge, it's heavily offset by a staggering billion-dollar cash runway, which is supported in large part by that Royalty Pharma deal we just talked about. Now, what's really fascinating here is how that $200 million from Royalty Pharma is actually accounted for on the books. It's recorded as a revenue participation right liability. In plain English, this is a contractual claim giving a holder a percentage of sales recorded as a liability on the balance sheet. So that upfront cash isn't just free money, it's booked as a $199.6 million liability with an estimated 11% effective interest rate. It is literally debt tied directly to their future success. All right, Section 4. Shifts in the pipeline, regaining full rights. Literally right after the first quarter closed, there was a sudden major change. In April 2026, Takeda notified Denali of its decision to terminate their PTV-PGRN collaboration agreement. This represents a direct shift in Denali's development pipeline, moving completely away from a shared risk and reward model for this specific program. So what's the direct results of that termination? Well, Denali regains full rights to the asset DNL 593 along with its related intellectual property portfolio. It's a real double-edged sword. The consequence here is that Denali now shoulders all future development costs entirely alone, which could definitely impact that cash burn we discussed. But conversely, they also retain 100% of all potential upside for the asset moving forward.
And finally, Section 5. The DNLI stock forecast, bullish now, bearish later.
Here is a quick snapshot of the short-term technical analysis consensus. The overall signal? Strong buy. Analysts are pointing to 12 buy signals, 3 neutral and 2 sell. The MACD is flashing a buy. The RSI is sitting neutral at 60.30, though the stock RSI is indicating an oversold condition, which actually triggers a sell signal. But collectively, these technical indicators are exactly why the short-term 30-day forecast targets an average price of $51.90.
But you have to see how this builds over the long haul. The average 2026 forecast is highly optimistic at $62.48. I mean, that's a predicted 198% surge from current levels. But the forecast turned surprisingly bearish as we look further out. By 2028, the average prediction drops back to $25.26, and by 2030, it plummets all the way down to $10.23. So the market clearly sees massive short-term catalysts with Avilaya, but there is significant long-term uncertainty. Now, before we wrap up, I need to clearly state the disclaimer directly from our source material. The information on this page is not intended to be financial advice. It is for general information only and should not be used to make any investment decisions. As your host for this explainer, my job is literally just to translate this data for you, impartially and clearly, not to endorse any specific viewpoints or tell you what to do with your portfolio. So I want to leave you with this provocative thought to chew on. With a massive cash runway, but some incredibly complex royalty obligations, will Denali's science outpace its long-term financial liabilities? It's the ultimate question, right? It perfectly sums up the high-risk, high-reward nature of the biotech sector. It's this fascinating balancing act of cutting-edge clinical progress against dense financial engineering. Keep a close eye on Denali's next moves because it's going to be thrilling to watch this unfold. Thank you so much for joining me on this explainer, and as always, keep learning.